Hello. Today I'll introduce you to the basics of technical analysis. I help you to understand the theory behind price action and the technical tools. We'll talk about support and resistance levels, trend lines, moving averages, oscillators and Bollinger Bands. Please remember that we don't provide investment advice. This material is made available for educational and marketing purposes only. Go to the tiomarkets.com to register your very own trading account. I have provided you a link here on the screen and also in the description. And please don't forget to subscribe to the channel so that you get to see all the future videos that we create for you. Okay, let's talk about price action theory. Why is it important to understand the theory? That's basically because technical analysis at the end of the day is all about analyzing the price action. And so therefore it's important to know the theory behind it. And really the price action represents the collective opinion of all the market participants. Therefore, it's far more important to understand price action itself than to have all the information or to know all the news items that impact the given market. And this leads me to my first topic in this video, support and resistance. Let's dive in. Identifying support and resistance levels is actually really easy. It just requires some patience and some skills for observation. So basically, if you find that there is a level from which the price moved higher, then you can conclude that there is more demand than supply. And the next time the price comes to the same level, we have to just follow the price action and see if we get a reaction from the level. If the market starts to move higher, then we know that this level again attracted buying, just like it did here. So we have a support level. Then the resistance levels, again the similar concept but the other way around. Now we have market moving to a level and then the move is rejected, so we know that this is a resistance. For one reason or another, the market, all the demand was overwhelmed by supply and the market moved lower. It could be a news event or it could be just technical noise in the market. Whichever way it is, we are quite happy as long as we see that there is a trading opportunity. Then the next time the market comes to the same level, we can already expect that there could actually happen something similar. So if we see that the market reacts to the level and starts to move lower, we conclude that yes, that was a valid resistance level and now the market actually is confirming this by moving lower, and we can join this move and make some points here. If you didn't do it earlier, please go and hit that subscribe button now. Then you can be sure that you get a notification each time we publish a new video. Thank you. Okay, now I have talked to you about horizontal support and resistance levels. What about diagonal support and resistances? They are also called trend lines. Let me show you with charts what I mean. This very same gold chart that we used earlier to recognize and identify support and resistance levels is a very good chart to illustrate how you can spot periods where you can find trades using the trend lines. Here, for instance, I have made a connection from this low to this low. And when a trader does something like this, he or she is making a bet that the next time the market comes to the level or close to the level, there is a trading opportunity. So in this occasion, the green arrow shows you where the market came exactly to the level and bounced higher. So there must have been people using this very same kind of analysis here, otherwise the price wouldn't have moved like this. Then there was another opportunity when the price came close to the level again. And eventually this led to a rally that forced the price of gold through the resistance level into a rally. So you can catch quite significant moves if you do your analysis right. Then again, staying with the same 1 hour gold chart, I have an example here where you can see how you can draw bearish trend lines. So first of all, take a high and the next reactionary high. And at this point, you are basically thinking that the market has some reasons to go down. You don't have to know the reasons, but you're just assuming the next time the market comes to the same diagonal resistance, it's likely that there is a trading opportunity on the downside. So you look for these moves back to the trend line. And when the market comes there and starts reacting, then you might have a profitable short trade. Here we had 1, 2, 3 opportunities on the downside. Then the next day there was opportunities to the upside, and in both occasions the market moved quite significantly. Then let's go and talk about moving averages. Moving averages, or MAs as they are often referred, they simplify price action and help us to see the market direction. So let me show you an example of a bullish MA setup and a bearish MA setup using charts. Okay, here I have a very simple bullish setup for Dow Jones Industrial Average CFD. This is in 4-hour time frame, and as you can see, the moving average is pointing higher and the price is moving above the average. So that is a bullish setup that helps you to find long trades. In the future videos, we'll talk about in more detail how to actually recognize the markets that are trending higher or lower. Then the bearish setup. Every trade comes to an end at some stage. Every trade reverses at some point. And once the price starts to move below the moving average and the moving average points lower, we have a bearish setup in the market. And this allows you to obviously look for short trades. Next, I want to talk to you about a set of indicators called oscillators. And with this set of indicators, it's important to understand that they really only provide us with indications and not buying or selling signals. And they need to be used in combination with other indicators such as moving averages. Let me show you what I mean. Okay, this is US oil chart in 8-hour time frame. And as you can see, we have a bullish setup here. The market is moving above the moving average and the moving average is pointing higher. So when this is the case, we're not looking at selling opportunities, but buying opportunities. And this is where the oscillators can be useful. I have added to the US oil chart 2 oscillators, RSI here on blue and stochastics here using red and gray. Now, let's talk about oscillators in general. They tend to move between overbought and oversold levels. In RSI, the overbought level is above 70, and in stochastics above 80. The oversold levels in RSI are below 30, like down here and there and there. And in stochastics, those levels are below 20. Again, down here and here and here. So as you might have noticed already, that when the price is moving higher, the oscillators go to the overbought area quite often. So we don't pay that much attention to those. But we pay attention to times when the market is moving down closer to the moving average, and this brings the oscillators close to oversold levels. So here, for instance, stochastics And if I make this a little bit bigger so that you can see, stochastics moves to 20 and slightly below it. And if we look at what the oil price does at the same time, it moves down a little bit more and then starts to move higher, taking the oscillator higher also. So that's how the oscillators can help us to identify times when we should be buyers in the market. From this point onwards, oil is moving lower, so you probably already recognize that there is a bearish moving average set up here. And now we are interested in oscillators moving above 80 level in stochastics and above 70 level in RSI. And as you can see, they highlight the times during which we might consider taking short trades. When oscillators are in the overbought area, when the market is trending lower, the risk of market reversing to the downside, i.e. continuing the bigger time frame trend, that increases. So that's the logic that the traders should understand about oscillators and moving averages. And the last indicator I'm going to talk to you about today is Bollinger Bands. It's an indicator created by John Bollinger, and it's designed to help traders to measure variability in price and to identify non-common price moves. Let me use a pound USD chart to show you how the indicator works and how you can use it in your trading. The Bollinger Bands indicator helps traders to measure several things. During the periods where the market is moving sideways for a longer period of time, you can see that this tendency to revert to the mean is stronger. The swings are quite big, and okay, they can be smaller too, but the point is you get more of these signals. But when the market is trending, the Bollinger Bands indicator tends to show you this by having the price action contained between the moving average and the upper band. For instance, here we have an uptrend, so most of the price data is between these two bands. And once the market starts to move to the downside, there's a big reversion there, and then the market comes below the band, the middle band or the moving average, and then most of the price action is well within the bands here. So there's several ways of analyzing the markets using the Bollinger Bands, and in the future video where we'll go into greater depth about the indicator, I will show you more on how to use this indicator in trading. Okay, thank you for watching this video. Please take a moment to subscribe to the channel and visit theomarkets.com to register your own trading account so that you can start exploring your trading business and learning how to become a better trader. Thanks again, and see you soon.